So, if you're a big law attorney, you might be familiar with an unwelcome surprise that comes every April, an unexpected tax bill that can reach thousands of dollars. This common problem stems from a significant mismatch between how your bonus is taxed when you receive it and what you actually owe. While firms typically withhold only 22% for taxes on bonuses, many attorneys fall into tax brackets between 32% and 37%, creating a substantial shortfall. Today, we'll explore why this happens and, more importantly, how you can prepare for it to avoid that dreaded April surprise. The root of this tax issue lies in how supplemental wages, like bonuses, are handled by employers. The IRS allows companies to withhold bonuses at a flat 22% rate, which is far below the actual tax rate for most big law attorneys. Think about it. If you're in the 37% tax bracket, that's a 15% gap between what's being withheld and what you'll ultimately owe. This standardized withholding system, while convenient for employers, can create significant tax shortfalls for high-income professionals like yourself. To get ahead of this issue, your first step should be understanding exactly how your firm handles bonus withholding. Start by carefully reviewing your bonus statement. Look for either a specific withholding percentage or the actual dollar amount withheld. If you only see a dollar amount, you can easily calculate the percentage by dividing the withheld amount by the total bonus. Don't hesitate to reach out to your HR or payroll department if this information isn't clearly presented. Knowledge is power, and understanding your firm's specific practices is crucial for proper tax planning. Determining your actual tax bracket is the next critical step. Begin with your gross annual salary, then subtract all pre-tax deductions such as your 401k contributions and HSA contributions. Don't forget to account for your standard deduction or itemized deductions if you use those instead. Once you have your taxable income calculated, you can reference the current year's tax brackets to determine your marginal tax rate. This process might seem detailed, but it's essential for understanding your true tax liability. Now comes the crucial part. Calculating your actual bonus tax liability. Add your expected bonus amount to your estimated taxable income to see if it pushes you into a higher tax bracket. Then, multiply your bonus by your marginal tax rate to determine what you'll really owe. Compare this figure to what will be withheld at the standard 22% rate, and you'll have a clear picture of your potential tax shortfall. This calculation is vital for proper planning and avoiding surprises. Let's look at a concrete example to illustrate this. Consider a fourth-year associate making $310,000 in 2025. After accounting for 401k contributions, HSA benefits, and the standard deduction, their taxable income is $260,000. When they receive a $75,000 bonus, only $16,500 is withheld for taxes at the 22% rate. However, being in the 35% tax bracket means they actually owe $26,250 on that bonus, creating a significant $9,750 tax shortfall. This is the kind of surprise we want to help you avoid. You have two main options for managing this tax liability. The first is to request higher withholding from your firm to cover your expected tax bill. While this reduces your immediate cash flow, it eliminates the surprise factor come tax time. Alternatively, you can plan for the shortfall by setting aside funds yourself, which gives you the opportunity to invest or earn interest on that money until taxes are due. This approach offers more control but requires disciplined saving. Whichever route you choose, it's wise to consult with a tax professional to determine the best strategy for your specific situation. Let's recap the 4 key steps to taking control of your tax situation. First, know your firm's withholding practices inside and out. Second, calculate your true tax liability by understanding your tax bracket and obligations. Third, make a concrete plan, whether that's adjusting withholding or setting aside funds yourself. Finally, don't hesitate to consult with tax professionals who can provide personalized strategies. Remember, tax planning isn't just about avoiding surprises. It's a crucial component of your overall financial success. Take action now to ensure you're fully prepared for next April. Concert Financial Planning is a registered investment advisor that specializes in serving big law attorneys. Nothing in this video should be construed as investment advice. If you have any questions about your specific situation, please get in touch with us at concertplanning.com or follow us on social media at ConcertFinPlan.